Yes, guys. Welcome back to another live stream webinar. We're back with another one here on the channel, and it's going to be another extremely valuable one this evening. We're going to do another webinar, and I'm going to kick it off in a few seconds/minutes. Just give me 1 or 2 minutes. I'm going to give everybody a moment just to tune in. Now, first of all, what's extremely important is, can everybody hear me loud and clear? That's the most important part, guys. Can everybody hear me loud and clear? Because today's webinar is going to be a very, very special one, because I'm going to do something that a lot of you have been asking for, and that is diving deeper into the key frameworks that I will be using in 2026 to make it my best trading year to date. So make sure to get a notebook, make sure to get a notepad, make sure to get a computer, a laptop, an iPad, an iPhone, a piece of paper, a pen, a pencil. Maybe you have a brother or a sister who's going to be taking notes for you, but it's extremely important that you pay close attention, because this webinar, as soon as it has ended, will be going offline and will be inaccessible and it will only be accessible for just a few. So therefore, I really want you guys to take notes, okay? Because again, after watching this video, you will have some life-changing information, okay? So what I'm gonna do, I see we have around 400 people watching, fantastic. Make sure to leave a like, and without further ado, we're gonna dive in. I know the interest rate decision in the US is currently ongoing. I haven't, to be honest, checked even. If I'm very honest as well, I don't really care, as I'm not in positions at the moment. All I care about is what is going to be said during the press conference, of which I will obviously create analysis, and that will help me then understand where potentially Euro USD will be heading next. So I can see Euro USD is pushing up slightly, meaning that most likely the dollar at the moment is weak, meaning that the rate can't went through, but obviously that was mainly priced in. So let's see what is said during the speech later. But then again, I'll create a breakdown of that for you guys in the Discord, as I always do. So without further ado, let's dive straight in, because I am dying to give you guys this important information, okay? So let's kick it off. So today, what I'm going to do is I'm going to give you the exact key frameworks that I use and I will be using throughout 2026 to make it my best year of my personal trading career. Now, guys, for those who do not know me, I have max allocation with firms like the Trading Pit, Alpha Capital, Funding Pips, FTMO. I obviously, for obvious reasons, and some of you might hate me for it, but I don't like sharing everything online. There are obvious reasons why I do not, or am not able to share certain things online. If I didn't have my face online everywhere, I would be much more willing to share a lot of it anonymously. But for obvious reasons, I cannot share everything. Now, you guys know I've shared many payouts in my life here online. I've done many breakdowns. I do consistent 5-figure months at the moment using this exact framework. So I want you guys to really pay close attention, because I'm going to show you the exact strategy today that I use to achieve these results. Now, I wouldn't be here today being able to share this information with you guys if I obviously didn't have some sort of social proof, which is obviously, in addition to those prop firm payouts, also the fact that I've been invited by prop firms themselves, like Alpha Capital. As you can see here, this is, I think, what it is, around a year ago maybe, where I was able to break down how I was doing 100K in 6 months, showing the exact strategy that we use. Obviously, this was an AUD USD breakdown where I did an interview. I've also been invited to England itself to show you guys more about how I trade on a podcast. I also did a podcast with the Trading Pit, and much more, okay? Now, not only myself, I've been achieving these results, but obviously you've also seen community members turn into actual team members, from Yella, who now has done a 16K month, from Oscar, who has been doing consistent 8K months. These are all individuals that show that not only myself, I am profitable with the strategy, but also others who I've taught the strategy to have been able to profitably implement the strategy. So it's really doable for everyone, because some of them ask me, but can I think, or do you think I can actually achieve it myself? Well, guys, Oscar was literally 17 and in high school full time when he got his first payout. So if he can do it, then obviously you can do it as well. Now, this week I'm going to do, or I did, a beautiful week here on USDJPY longs. And today is going to be a full explainer where I'm going to be explaining the exact reason why I took a USDJPY long. And I'm going to be explaining my exact fundamental framework together with my technical framework so that you can copy and paste these two frameworks, combine them together, and start profitable trading within 2026, okay? So what we're going to do here is we're going to start the core driver of USDJPY strength, because obviously you guys can see that I was buying USDJPY, but now you're obviously wondering, Fabio, why were you bullish on USDJPY? Now, I'm going to start with a fundamental breakdown because that's what most of you like, and then we're going to dive into the exact technical reason, okay? And then these two individual components, once they're kind of like put together, they become a plus, and plus means in Dutch plussen, which means make a lot of money. So what you need to understand is that what drives a Forex market, guys, is, and I've talked about this many times, is interest rate differentials. And all you simply need to understand is something that is known as that higher yields attract capital and lower yields attract less capital. All right. This is extremely, extremely important to know. This is the key concept of Forex trading. I'm going to show you guys an example in a second, but it's the reason why markets move from point A towards point B. Now, what is actually happening when you have something called an interest rate differential is that traders or banks, they borrow in Japan where interest rates are low, and they invest in higher yielding countries or economies such as the United States and the United Kingdom. And as long as there is something called an interest rate differential, which is substantial, there is going to be a massive fundamental opportunity to make a lot of money. So what we can see here is that it increases the overall demand for a currency, making GJ and UJ fundamentally bullish. Now, I've popped up a chart here, and this chart is extremely important, guys, because it shows the interest rates for the United Kingdom, for the United States, and for Japan. Now, the gray line here at the bottom is the Japanese yen interest rates. As you can see, for a very long period of time, interest rates were even sub-zero, and only recently, since 2024, have interest rates gone above zero. But you can still very clearly see that there was something very interesting happening in 2022. Now, 2022 was a very special moment for Japanese yen pairs because of the fact that after COVID-19, the world or the global demand for products started going through the roof. Obviously in 2020, 2021, nobody was spending any money because everybody was absolutely terrified as we had to deal with COVID-19. Some people obviously thought the end of the world is near, so I'm not going to spend any money, but also at the same time, you couldn't even leave your house in some countries, again, making it very difficult to spend money. Factories across the world were at a standstill, and that across the globe caused global demand to really go down. So what central banks in the end did was that they implemented extremely low interest rates, both in the US, both in the UK, but also in Japan. As you can see, interest rates were near zero. Now, what is interesting about very low interest rates is that it causes people like yourself and I to start spending money very aggressively because it becomes very cheap to start borrowing money. So what do we start doing? We start buying, for example, a house. We start buying a boat. We start buying a car because we can take out a loan against very low interest. Now, this is good for a global economy, obviously, and it sparks, let's say, growth and it sparks inflation. But where the real divergence came was in 2022 when suddenly inflation started going through the roof, because when everybody starts spending money, inflation starts going up. So what happened is that in 2022, inflation was so high, it was around 8% in the United States, that interest rates needed to go up. And the reasoning behind that, and let me just write that down for you guys, is because high interest rates slow down the economy. And then you might be wondering why? Well, because it becomes more expensive to borrow money, meaning people will spend less and that will then cool down the economy, because when inflation is too high, nobody's happy because everything suddenly becomes more and more expensive. Now, this at the same time is a key point, as I mentioned earlier, because it started a massive divergence between the UK, between the US and Japan. Because if you go and look at the United States and the Japanese yen, or the US dollar and the Japanese yen, between 2016, which is the black line here on the left, and 2022, which is the black line here on the right, you can see that UJ was relatively flat. We weren't actually moving anywhere until what happened here in 2022, the interest rate differential gap started widening. So what happened is that interest rates, let me just change this real quick. Interest rates in the US went from, let's say, 1% or 0.5% to, let's say, 5%. Interest rates in Japan went from 0, or let's say minus 0.25, to 0, meaning that there was a massive interest rate differential. And what does this mean? It means that you can borrow money in Japan for 0% interest, meaning that you don't pay any money to borrow it, essentially, whilst you can then invest that cheap borrowed money in the United States against 5% interest. And this is also known as the carry trade, causing fundamental demand in itself, guys, causing fundamental demand for itself for the US dollar and not for the Japanese yen. Because what will people start doing? They borrow in Japan and then invest in the United States. So when you borrow in Japan, you borrow in Japanese yen. When you then invest in the United States, you invest in US dollars, meaning you buy Japanese yen at first to just sell it. So you sell Japanese yen to buy US dollars, because the loan that you take, let me just again write that down, because the loan that you take out is in JPY and the investment that you make is in US dollars, guys. So this is simple economics, and this is the reason why when that overall interest rate differential gap started getting bigger and bigger, what did people start doing? People started borrowing that money in Japan against the very low interest and started investing it here in the US against 5% interest. So what you see is here, between 2020 or 2016 and 2022, when the interest rate differential was very low, what happens here? We're relatively flat. Then here, boom, in 2022, a massive bull run starts on US dollar against the Japanese yen because it simply follows the overall interest rate differential gap. So as you can then see from a fundamental perspective, it just made sense that USD/JPY was creating higher highs and was creating higher lows. And the same goes for GJ. If you look here, again, the red line is the United Kingdom interest rates. Once that interest rate gap gets larger, what happens to GBP/JPY? You can see between 2026 and 2016, and 2021, GJ was relatively flat. There was even, let's say, a long period of an overall downtrend here between, what was it, 2018 and 2020, because the United Kingdom was relatively flat and even cut their interest rates here into 2020. Then what happens? From 2021 onwards, where again here, 2021 onwards, when the overall interest rate gap started widening, meaning in the UK you could invest your money for 5% and in Japan borrow for 0%, what happens? Everybody borrows money in Japan, invests it in the United Kingdom for that higher interest, causing again an overall bull run to occur on GBP JPY, making the overall fundamental analysis play extremely, from, let's say, the perspective that I just explained, easy to understand. So you can see, to understand a longer term trend here for fundamentals on pairs like UJ, like GJ, you don't need to look at every single news announcement, say, hey, today, this month, we're going to see bad numbers on NFP. Next month, we're going to see good numbers on NFP. No, what you need to look at is the overall trend of the interest rate differential, understand where that interest rate differential is going to head towards, and then you can make a longer term play here on a pair like GBP JPY or on a pair like USD JPY. Now, what's extremely important to understand, guys, is everybody following me so far? Because I want to know if you guys are kind of like, being able to comprehend the information. Is everything going good so far? Does everybody understand and follow me? And is everything clear? This for me is extremely important at this point in time. I want you guys to be able to follow everything that I'm explaining here, because ultimately, without even doing one piece of technical analysis, you now understand why a UJ keeps on trending in towards the upside, why a GJ keeps on trending in towards the upside, right? Okay, fantastic. Very happy to hear that you guys are understanding. Now, you might still be thinking, but Fab, this is still relatively unclear to me. Well, don't worry, because now I'm going to give you guys my overall playbook for central bank speeches and how you can interpret them as well. So when we analyze an overall central bank speech, the goal is to understand how that central bank sees the economy and what that means for future interest rates. So what's extremely important for you to understand, guys? And let me just zoom in here. What is important to understand? It's not about a single number. Let's say unemployment, or let's say NFP comes in bad, does not mean that the dollar is going to be weak. This is extremely important to understand. The key to understanding fundamentals is understanding what contributes to future interest rate differential expectations. And this again may sound very complicated, but it's not, because all we are doing is listening. We are listening to what a central bank wants to see in order to make a fundamental interest rate decision. It's as simple as that. And in these speeches, sorry for the handwriting, but you guys get me. In these speeches, you will understand if a central bank is focused on, for example, inflation, focused on, for example, growth, is, for example, focused on unemployment, is focused on the bond market, whatever. And then all is up to you is then to look at the trend related to that number, so that you can then make an expectation or a let's say calculated thought on where that interest rate gap is going to start moving towards. So when you look at, for example, here, the interest rate gap between the two, it was massive between 2023, 2024, and it was only getting bigger, right, from 2022 onwards. That's why the overall trend here starts in 2022, because the gap only got bigger. So again, this moving of price is all based on what? The moving of price is based on future interest rate expectations. Okay, this is extremely important to understand. It's based on future expectations. So the reasoning why price started pumping in 2022 already, when the gap was very, very small, was because people were expecting that in the future, let's say in the coming 2 years, that gap was only going to widen further and further. Hence why that GJ and why UJ started trending so hard in that, let's say, early 2022, that early 2021, whatever period, right? Because the future expectation was that that gap of interest rate differentials was only going to start getting bigger and bigger. Now let's get back into this. Now we need to look for signals in 3 areas, okay? So first of all, we look at inflation, because rising or falling prices determine whether the bank needs to tighten, meaning lower interest rates, okay? And then let me just add to that for you guys who don't understand. Tighten, I wrote it down wrong here. So tightening is higher interest rates, or loosen is lower interest rates. Now, when we have higher interest rates, this means that you are, and with tightening, they mean they need to control more the economy. When you have higher interest rates, it becomes more expensive to borrow money, and therefore you are pulling a rope, you're tightening it. You're going to put the interest rates up, meaning that the economy is going to start cooling down. But for us as traders, the most important part to understand interest rates is that higher interest rates are good for a currency and lower interest rates are, let's say, I don't want to say bad, but weaker for a currency. Okay? So this is just the key fundamental concept that you need to understand. So again, rising or falling prices determine whether the bank needs to tighten, higher interest rates, or loosen. Now, what you need to understand is that, guys, again, higher interest rates, or let me put it this way, higher inflation requires higher interest rates because of the reason that I just said. When inflation is very high, you don't want inflation to get out of control and suddenly inflation be 10% and everything becomes more and more expensive. So what happens? We get higher interest rates, meaning it becomes more expensive to borrow money. So people start spending less and then inflation starts cooling down. When we have low inflation, this requires something else. This requires lower interest rates because of the fact that lower interest rates boost spending as borrowing money becomes cheaper, meaning people start spending more. However, those lower interest rates are what causes a currency to be weaker. So that's how we look at inflation, okay? So you have CPI, you have PPI, you have PCE. Let me just add those for you. So we have CPI, consumer inflation. We have PPI. This is producer inflation. So CPI is on our side. PPI is on the producer side. And then you also have PCE. Now, then we look at growth because strong economies can handle higher interest rates. So when we talk about, let's say, a strong economy, you see, okay, growth is very high. We have a very healthy economy. And these can often, or more often than not, handle those higher interest rates because to handle higher interest rates, you need to have a pretty strong economy because spending is going to start, let's say, being reduced, while weak economies cannot. And then we look at monetary policy guidance, where central bankers reveal how quickly or how slowly they plan to adjust the overall interest rates or bond purchases, okay? So these are kind of like the 3 main pillars, and they're going to become more clear in a second because I'm going to break them down for you. Now, what we look at next, guys, is on this side. We need to pay close attention to the phrases showing the confidence, the caution, or the concern. Because central banks rarely say things directly. So their tone and the wording matters just as much as the numbers. Okay, so by combining the clues in these speeches, we can understand whether the bank is leaning more hawkish, which makes a currency stronger. And hawkish, guys, for again, people who don't understand, hawkish, and it's not strange because it's kind of like a lot of information to comprehend. Hawkish means higher rates, means stronger currency. And then on the other side, we have dovish, which means lower rates, means weaker currency. All right. So now when it comes to actually understanding these clues, what I did to take that USD/JPY long, because I've kind of taken a little bit of a detour, but we're getting into the juice now, because the central bank on the 1st of December took place in Japan. And a lot of us don't really look at this speech because there's not really a data point attached to it, right? We think, okay, well, the guy spoke, maybe let's just read a headline. And then in that headline, he said something specific. Or we see, let's say, a news headline on Bloomberg. We see a news headline on Twitter, on X, whatever. But it's actually the most important thing that you need to take note of, because this speech is going to talk about that interest rate differential And in this speech, he's going to say what data that's being released throughout the week, so these numbers, what that will do to the future interest rate differential, if you guys understand what I mean. So the actual, let me just go back. So the actual most important thing that you need to be looking at, and let me now type again, is the fact that, first of all, we need to understand the speech, right? Then second of all, in that speech, he mentions what data points to look at, okay? So in the speech itself, he will talk about the data points that are released throughout the week. Now, these speeches can be found on the central bank's websites themselves. So for example, here for the BOJ, you go to boj.com, if I'm not mistaken, that's the website. And then that's where you can find the overall speech, okay? So what I did was that I analyzed these speeches so that I then understand at what angle I need to look at the overall data that is coming in throughout the week. Now, this, guys, again, because I'm going in a long circle, but this overall long position that I took on USD/JPY, that will now be broken down based on inflation, based on growth, and based on monetary policy. And you will, after watching this video, understand how I analyzed it. And by taking notes, you can then understand how to analyze it yourself in the future. So first of all, we have inflation. That's the first point that I analyzed. So inflation, and this is literally a quote from the speech that he did. Inflation is going to decelerate temporarily to below 2%. So if you remember what I mentioned about inflation, is that overall we want, when we see lower interest rates, guys, when we see lower inflation, we need lower interest rates. But lower interest rates do what? They weaken a currency. So overall, this statement that was made, and let me just get it back to where it was. It's not going back. We'll do like this. This overall comment that was made was ultimately bearish. Decelerate temporarily to below 2%. It's not the best red that I'm getting here. Let me get this. Decelerate temporarily to below 2%. This means overall inflation is expected to go lower, and low inflation is overall bearish for a currency because you expect lower rates, right? As simple as that. So here, the year-on-year rate of increase in the CPI is likely to decelerate temporarily to a level below 2%. If inflation is falling, the Bank of Japan has no need to raise interest rates, which keeps the yen weak. And again, raising of interest rates is good for a currency, but there is no need for it, meaning that it is bearish for the yen. Then here, current inflation still comes from temporary factors like food prices. So what he said in his speech, this is likely to be largely attributable to temporary cost push factors. So this means temporary inflation does not convince the Bank of Japan to tighten policy, meaning tightening higher interest rates. So again, no higher interest rates, which again is bearish for the yen. Furthermore, in his speech on inflation, he said, I quote, "It is necessary to pay attention, but at this juncture, these developments do not appear to be gaining strength," meaning the Bank of Japan sees no urgent inflation threat, so they stay dovish. And again, dovish means what? Means low rates, means weak currency, bearish for the yen. So overall, the quotes that he made were bearish for the Japanese yen. So then what do? I go to growth. Well, what is said on growth? Japan's growth is only modest. So I quote, "For the time being, Japan's economic growth is likely to be modest." Weak growth means that the Bank of Japan cannot raise interest rates aggressively, keeping again Japanese yen weak. So remember from here what I said, strong economies can handle higher rates whilst weak economies cannot. So meaning that it is bad for the yen. Now, number two, household consumption is soft and under pressure. So consumption, I quote, of non-durable goods has continued on a decreasing trend. The burden of price increases on households remain high. Explanation, overall, means that weak spending makes the Bank of Japan cautious about tightening. Again, they do not dare to put interest rates higher, meaning weak Japanese yen. And then the last one, uncertainty surrounding the outlooks for Japan economy is gradually diminishing, meaning the economy is not strong enough yet for the Bank of Japan to commit to fast tightening, which is again higher interest rates, means again bearish for the yen. Okay, so far you guys hopefully understand it. Now, once again, we go into the final part, monetary policy. So in his speech, he said, I quote, "The Bank of Japan intended to take flexible measures such as increasing government bond purchases." Explanation, guys, again for you. Buying more bonds pushes interest rates lower, okay, which weakens the yen. I'm not going to go into the full explanation on bonds. I'll drop some documents on that inside Discord. But again, buying more bonds pushes interest rates lower, which weakens the yen. Then again here, real interest rates are significantly low levels, considerably below the neutral rate of interest. So when real rates, guys, and real rates are ultimately interest rates minus inflation, all right, that's very important to understand. When interest rates, or when real rates, are very low, investors don't want to hold the yen because it offers very little return or even negative. So again, bearish for the yen. Then number 3, rates or raising the policy interest rate is about a process of easing off the accelerator, not about applying the brakes. Again, if I would read this for the first time, I'd think, what the fuck is the AI actually saying? But it actually just means the Bank of Japan is not planning strong tightening, which means not very high interest rates. So they'll still keep financial conditions very, very loose, meaning lower interest rates or very slowly raising of interest rates, which is weak for the yen. Then point number 4, he quoted, "We are actively collecting information and intend to make an appropriate judgment." So the Bank of Japan is still waiting and they're not ready to tighten aggressively, which is again bearish for the yen. And again, tightening means higher interest rates. Then the last part of the overall speech that I quoted, "Even if the policy interest rate is raised, accommodative financial conditions will be maintained." Again, what does it mean? Even if they hike interest rates, Japan will still have a very loose policy, meaning the Japanese yen stays weak. Okay, so based on the 3 key pillars of fundamentals, I clearly understand that the Japanese yen from that speech is still, 1, regarding monetary policy, very focused on a more overall loose approach, meaning they're not looking to very, let's say, overly tighten or let's say increase interest rates very, very hard. All 3 key pillars of my fundamental model, framework, whatever you want to call it, are all bearish for the Japanese yen. Sometimes what you'll see is that, for example, inflation is up, growth is, for example, down, and monetary policy is unclear, right? Because these 2 mainly work together to form kind of like monetary policy. But if it is unclear, then taking a fundamental approach, or let's say applying a fundamental bias, is going to get a little harder because you have multiple factors fighting against each other. So if, for example, inflation, and let me just write this down for you guys again. So let's say, and this is pretty interesting again, at least I find it interesting. If inflation is high, what do you want? You, as a central bank, you want higher rates because higher rates cools down inflation. So let's say suddenly, like in the United States, gas prices go up by $10, whatever, crazy, they go up, let's say 50%. What can you do? You can raise interest rates, which cools down inflation. However, sometimes at the same time, you will, let me just get out of the way, you will see that growth is slow, high unemployment. This is very bad because what you then have is something called stagflation, where you have a very stagnant growth but high inflation. So then it's unclear what the central bank needs to do regarding monetary policy, making it very hard to understand what the overall expected divergence or interest rate differential is going to be in the future. So then, based on fundamentals, you could say, okay, this is not ideally the best pair to trade at the moment. Let's stay out and wait for the next update. All right. So let's see. Does everybody understand where I am at so far within this overall explanation? Is the fundamentals behind this trade clear? Because I mainly just broke down the Japanese yen. I'm not going to go into the full dollar because all we need to understand is as long as that interest rate differential gap maintains itself as wide, so for example, above, let's say 2-3%, USD/JPY will continue going up. If that gap suddenly becomes very, very small because Japan is suddenly talking about putting their interest rates at 2%, then UJ is very likely to fall because the gap will get smaller and smaller. Okay, fantastic, guys. I'm happy to hear that everybody follows. Now, let's dive then into the most interesting part, and that is obviously the overall technicals of the UJ trade in itself. So I see EURUSD made a big wick, but that's perfectly good. Let's dive into the actual position itself, because now what I want to show you guys is the actual technical model that we then apply to actually find an entry, and I'll dive into that speech on the 1st of December. So first of all, the 1st of December, which took place on which day? Here. This is the 1st of December. So what you see is that after that speech, a V-shaped reversal came into play. And this is very interesting, guys, because based on that speech, you can see that the market starts pushing up higher. So what are they doing? They're making the market believe that we're going to start seeing a new rally in towards the highs. Obviously, let's say some bullish 4-hour candles is going to entice some people into getting into buys. What do we, for example, have over here is a relatively bullish candle, which could, for example, say or enable people to get into a position, furthermore, based on the fact that we have, let's say, a support and resistance level here, or maybe even a support and resistance level, which you could kind of expand here. Not sure how people would view that, but you guys get kind of like the information I'm trying to share with you. Now, based on the strategy that we use, again, what do we look at? We look at the overall impulsive phase here in towards the highs, which broke market structure in towards the upside. So this is overall part one of what we would be doing on UJ over here. Now, step two, and let me just write those down. Part number one is identifying market structure. Part number two is then identifying PVD. Number three is identifying LIC. Number four is identifying FDB. And number five is identifying supply and demand. As simple as that. No need to really make it more complicated. So based on the market structure here on the 4-hour time frame, what can we see? We are bullish from where? From this low in towards this high. Then based on PVD, what do? We draw in the premium versus discount tool from the swing low in towards the swing high, and everything below the 0.5 fib is overall a good potential buy. So we have, yes, discount reached because we're below the overall 0.5 fib. Then market structure, we can also take off that box because we are bullish from the overall low here in towards the overall high here. Then based on liquidity, what do? We look within the overall impulse in towards the highs. Where do we have liquidity? We have liquidity here, and we have liquidity here, and we even had some liquidity on this little bump over here. I expand the line to the right, and what we can see is that the first time we came into these two liquidity points, the market gave us that V-shaped reversal that took place on the 1st of December when that speech took place. Now, that means that on the 1st of December, we already had the overall bullish confirmation. Now, how most traders would approach the setup here is that they would look at the Fibonacci retracement and they would say, hey, I have a 618, stop loss on the next fib level, and we target a new high. However, what you see happening is that the market then just continues pushing in towards the downside. Well, why? Because we didn't have the fourth point of confluence, which was the so-called FDB, meaning we didn't have bullish confirmation to actually enter the market. Because if we look at the phase of the market that we were in, and I call this the so-called pullback phase, you can very clearly see that the market was making an overall retracement in towards the downside. Now, what you want to do is that when the market is retracing in towards the downside, understand what phase the market is in. So what we had here was an overall pullback phase where we had a so-called supply chain forming. We had the so-called, let's say, imbalances, buy for the sells, whatever you want to call it, pushing the market down lower and lower. You can see that we were forming a low, and we had a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, until what happened? We got a FDB. Where did the FDB happen? Right over here on the lowest liquidity point. What do we get? Breaking towards the downside, breaking towards the upside. And fractal breaks, guys, FDB is a fractal breaking structure where you see on the individual candlesticks here that we get a, let's say, push down, pull back, push down, pull back, push down, boom, push in towards the upside. What do we see? A clear demand zone forming. Now, if you didn't find this enough confluence then to enter, here we had another fractal break in towards the upside, the so-called double fractal break. Meaning at that point in time, yes, we had the overall FTB confluence. Here we had the liquidity confluence. And through those double fractal breaks, we started forming a demand chain further in towards the upside. That is then also the moment when you can enter. So you can enter on the first one, stop loss underneath the lows. And then obviously you're going to be targeting whatever target is suitable for you. You could still be in this position as it's perfectly valid. And then here on the second fractal break, again, stop loss underneath the low, you would be able to scale in. That position based on the 1 to 2 risk to reward would have already hit the overall TP. And then you want to be scaling in based on the overall market structure that is then provided. So for example, now here on USDJPY, it's slightly unclear. And let me just clean up the chart for you guys because no need to keep it that messy. Here we have the overall impulsive phase in towards the highs. You can see here as well on the 1 hour time frame, nice break of structure up. We took out some ascending lows here. Let me just zoom in for you guys. And from there, after that, we head up higher again. Now, what we've had here so far is a massive overall impulsive phase in towards the upside. Where do we have liquidity? We have, for example, liquidity resting here. So what I would now be saying on USDJPY is I would be waiting and I would say, okay, I'm already in very two nice positions. Premium versus discount tool drawn in. We can see, okay, we haven't yet retraced into discount. So if we retrace into discount, I would be looking at, let's say, this low here as well. And I'd be saying, okay, let's wait for either one of those lows to get taken out. And then from that moment onwards, we can scale into that position following the overall 4 hour market structure, which was previously in the pullback phase, but is now once again in the overall impulsive phase as we have what? We have taken out the final liquidity hoe here. And as you can see, guys, this is how you can then combine the overall technical strategy that I just explained together with trading fundamentals based on the overall framework that I just, literally explained to you step by step. And that is why on the 1st of December, I was actively looking for a long position on UJ. However, I didn't yet get the overall technical confirmation. If we would have broken above, let's say this high here and this overall supply zone, and we would have broken this and then seen the retest down, I would have hopped into a long. But what happened? The market just continued with the overall order flow down lower. So I waited for my entry confirmation here. And then I had both parts of the equation filled, which was on one side, the overall fundamental play, and on the other side, the overall technical play. And that's how I combine the two into a framework that not only works for myself, but also for a very, very large group of people. So that's it, guys. I want to thank you all for watching. I think another extremely valuable webinar. What I want to say with this framework is, again, guys, the framework in itself works. We're nearing the end of 2026. I've done over, I think, 500 individual different YouTube videos this year, from daily market outlooks to just educational videos to short form content explaining this strategy. I've never gatekept any piece of information, and I'm always here to share everything with you guys. Now, what I want to do moving in towards the end of this year is give, again, some of you the opportunity to potentially work with myself and the team. As you guys know, we give daily live sessions explaining these exact concepts in greater detail, because a lot of people, even though I give you all of these individual confluences, both the technical framework, both the fundamental framework, you're still going to spend another 6 months, maybe another year, maybe another 2 years, still trying to figure it out, still hopping from strategy to strategy, and still thinking, hey, why is this whole thing not just simply working for me? So what I'm happy to do, guys, is for you who feel still lost and feel like, okay, this strategy is definitely it. I can see Fabio printing with it and explain to me in great detail. I feel like I understand it, but it's still very, very hard to actually make money with it and get those consistent prop firm payouts, get max allocations, and start making a monthly income consistently, like myself, but also like Oscar, like Yella, like Rucker, like the entire team, and like many mentorship students are now currently starting to do. I'm happy to open up the calendar of myself and time. I'm going to pin the link to that calendar here in the chat. Feel free to book in a call. It's completely free, guys. But it is simply a call where you will have the opportunity to find out more of how I can potentially help you. And again, It's completely free. All you can do is just book in a call, get on that call and see where you currently stand and where you could potentially go towards. The worst thing is that you find out that maybe this strategy is not for you. You're looking for something else. But at the same time, if you feel like this strategy is definitely something that you want to pursue, you want to learn more about, and yeah, you feel like you're still missing that final piece of the puzzle, hop on that free call and you discover more. And if not, then just keep on watching the content and keep on watching the daily market outlooks, keep on watching these kind of webinars, because I'll be here and I'm not leaving anytime soon. So guys, I want to thank you all for being here today. It means the world that you guys took the time here with around 480 people to watch this valuable webinar. I'm still planning on what to do. Probably I'll not release the recording, only for people that work with myself and the team, because again, the information here was so valuable. I hope you have been able to take notes. If you have questions, obviously always feel free to be inside Discord, because I'm just going to be there helping you guys out as always. And yeah, guys, thanks for taking your time to be here. And again, the link to booking a call for free is here in the chat. Feel free to do so. I don't really talk too much about booking and calls or whatever, but I feel like because I don't talk about it, a lot of you are not even aware that there is an opportunity to kind of like get these kind of like consultation calls. And again, I'm here to help, here to show you guys how it's actually done with as much transparency as possible. So I just want to thank you guys a lot for, again, taking the time here. I wish you all the best for the rest of this evening. Arsenal should be playing in around 12 minutes. So I'm going to go ahead and watch them. And yeah, I'm going to enjoy the rest of my evening. I think Manchester City is also playing against Real Madrid. Yeah, guys, I hope you were able to absorb all of the information, and any information that you have or any questions, excuse me, that you have, ask them inside Discord, as I'll be there to guide you. Thanks, guys. Wish you all the best and speak soon.